Corporate demand is growing rapidly from energy, airlines, energy-intensive industries, etc. Thanks to Klima and Toucan for really leading the way for tokenizing these credits in the blockchain. Let's be doing something to the transmitter, sorry. But it's not enough, right? If you look at what's happening, if we do nothing else, we're gonna hit 3-degree warming this century. And we need to throw the kitchen sink at all of these things so that we can rapidly scale. Why? Because if you talk about nature-based solutions, if you talk about all these other approaches, nature-based alone would require something like 35 times the size of the UK to sequester 10 gigatons of carbon. That's just not going to happen. There isn't enough land on Earth to do it. So we need everything. What is everything? Direct air capture, forest carbon, biochar, soil, blue carbon, enhanced weathering. We need it all. This is a nice little tool. I encourage you to check it out. It's called the Road to 10 Gigatons. You can go mess around with this and see what it takes to get there. And in addition, we need these things now, which is why it's really important to have transparent forward markets in contracts for all of them. And I'll talk about why. So when you start to mess around with this, you get to see the scale of this. And honestly, these numbers are probably wrong. It's a nice little calculator, but they're probably off by maybe a factor of 10. But I'm gonna hone in on cost, right? Because we need to drive the cost curve for this stuff down rapidly. We need to do it now, because if we wait and say, if you take direct air capture, it's supposed to be cheaper later. So everyone who's in the market now is going, I can just wait. But if we wait, we're not gonna have a habitable Earth, right? So we need to make this a tenable choice right now. And the good news is that if we do that, it has compounding effects. And I'll show you what this looks like in the yield curves, right? So what's preventing the scale and liquidity? Carbon assets are kind of treated as this one class of carbon credits, but they're radically different in terms of how fast they sequester carbon, over what time period, their co-benefits, a bunch of stuff. Because of this, it's actually hard to price. And if you're a corporate purchaser, you want to lock in that price because you have year-end commitments. You want them now. And project developers, managing this is really difficult for them, and it's hard to raise money. And lastly, and I hope this isn't too spicy, but fungibility. A lot of these carbon assets are not fungible over methodology, and they're not fungible over time. So we're going to look at what that looks like. So if you just look at carbon asset yield, this is a little credit to Peter Olivier from Undo. I love these diagrams. You can kind of see that enhanced rock weathering, forest carbon, and biochar actually sequester different amounts over their entire lifespan, right? If you're looking at an enhanced rock weathering project, it's an exponential. Forest is an S-curve, biochar is linear. And fundamental financial primitives for managing the risk of these projects do not exist. So with forest, for example, right? If you look at something like this, if there's a forest fire, your actual project risk is radically different than where it started. And what you're looking at is greenwashing, right? I'm not saying people who are doing greenwashing are bad. This is just what they have to deal with, right? Like they're offloading the risk to the people who are doing the projects. They're like, well, I can just buy the thing. And yeah, it's greenwashing, but I can't go there and do anything about the forest fire. And furthermore, when you model the risk, there's also modeling risk in other methodologies, right? So enhanced rock weathering is pretty predictable, but that's what we think. We scale it up, we might learn something different. And lastly, carbon assets, like I said, are not fungible by time and method. So if you take a sliver of time right there, how much an ERW project is sequestering is radically different than forest or biochar. But we're selling them like they're the same thing. Carbon assets, I'm gonna keep going on this one. All these factors contribute to illegible and illiquid markets, even in blockchain, right? Because blockchains are for legible markets, but it's actually really difficult to get to that level. So you have non-fungibility, you have non-existent yields for holding these things, right? Because you're basically just hoping that people buy more of them, but then there's nothing to do with them once you get them, right? Except retire them. And you don't have financial primitives to manage the risk of those projects. So what does this actually mean for an asset manager at, say, Deloitte that has billions under management and wants to offset to net zero by 2030? If you take carbon direct removal, these are mostly done as OTC forward contracts, so over-the-counter forward contracts. They're done once, and there's no liquidity. So let's say Deloitte in 1 year sequesters all they need to meet their goals. They can't sell those contracts to someone else. Well, so what is that thing worth in year 3, 4, 5, 10? There's no way to find out. And lastly, this is the worst problem. CDR, like I said, is perceived as a depreciating asset. So people can say, well, I'll buy forest carbon now because it's going to be worth more later. And I'll wait to buy CDR till it comes down. This is just the classic tragedy of the commons problem. No one is going to act till it's cheap enough, and then it's going to be too late. So we have to solve that problem. So quick recap, price discovery is a problem. Transparency is, we're bringing some transparency to markets, but it's still a problem. Fungibility, it doesn't quite exist at the level we want it to exist for this to be a tradable asset. And the financial products on top, once you have them, they don't exist. There's no way to go out and hedge these positions. So what do I think we need? Glad you asked. I think maturity and methodology pooling is one place to start. I'm going to walk you through that. Once you have that, you might be able to have markets and forward contracts. And then on top, Phil from Float Carbon and some other folks have been talking about derivatives markets. So I'm going to talk about perps. So first, pooling by maturity and methodology. Why would you do it? How would you do it? This is just a hypothetical, right? So the good news is Toucan already exists. There is a pooling by methodology. It's the NCT. You can go buy it today. It also has some decent governance in place for who gets to join that pool. But it's just a start. You can see in these yield curves that these are radically different assets, so maybe you'd be interested in pooling them by methodology. Maybe there's an ERW token. Maybe there's a biochar token. And then, once you have that, like you can basically see from the ERW curve that carbon delivered in 2028 is radically different from carbon delivered in 2025. So you could price these by year, right? ERW 2028 is still in the atmosphere. ERW 2025 at the end of the year can be claimed and retired. So these would make the yields in these projects finally visible, because you could have these pools that exist where people can come in and say, hey, I have an ERW token, I'm an enhanced weathering project. I would like to sell 50% of my project to be delivered by 2040 into this pool. I can get forward financing, but you get to hold an asset that is only going to appreciate because I've given you a huge discount. Over time, as people trade in and out of these pools, you get to the market price for what carbon delivered by a certain methodology at a certain time is. And I think that's really powerful, because a project developer can now come in and say, hey, it's great to know the price of this, but you're telling me I can sell into this pool? That's transformative for project developers. They cannot do that today, right? So what's next? Did we solve all the problems? Not quite. Offsetting entities still can't lock in prices for their offsetting goals. This could be something like a carbon option. Net neutral goals that are set for fiscal years, everyone waits till the end of the fiscal year to actually meet their goals, right? Which means there's a flurry of trading activity in December. I already mentioned the commons problems. We cannot wait for CDR to have a better price in 2040. We have to do it now. And lastly, while I look like I am saying we should speculate on these things, what's really important is we need physical settlement, which I'll explain what that is. But basically, we don't want to just speculate on the price. We want to actually be able to claim the underlying asset and retire it at the end of the year, which is what physical settlement will let you do. So I'm going to talk about perps real quick. If you've never heard about them, they're invented in 1992. They didn't find a use case until 2016 when BitMEX introduced perps for Bitcoin. Now, all you need to know about this is this number right here. This is the perps volume on just Binance and FTX last year. It's $11.7 trillion, right? So that's just transactions. And if you have a fee that maybe goes into a project developer fund from a exchange that funds a perp for carbon, that could be an interesting idea. So I'm going to run through this one real quick. Derivatives as a class of financial product are interesting because they let you hedge against directional movements. So let's say you buy carbon that's worth $50 to $100, you get it for 55, but you're Deloitte and you have like, I don't know, $20 million worth of it. You want to be able to be insulated against that when the NCT pool moves against you, right? When someone goes like, actually, forest carbon is cheaper than we thought, right? You want to be able to say, oh, okay, well, I can make some money on that, because risk capital needs returns in order to be deployed. We can't just rely on their best behavior to do this. So I'm not going to cover futures or options. Don't worry about it. Very simply, just think of it this way. If the price of an NCT on Polygon today is 10 bucks, but there's a bunch of people speculating on the future price, and it moves from 10 bucks, that's the mark price. The price on Toucan is 10 bucks, that's the index price. At the end of each day, people go, everyone who is long Toucan, who thinks this is going to go up, will take their price, index minus mark, and everyone who's long will pay everyone who's short if that number is positive. Everyone who's short will pay everyone who's long if it's a negative. That's it. I can show you in practical terms what that means, so don't worry. Let's assume we're trying to get Deloitte to invest in Undo, which is a carbon direct removal project, carbon dioxide removal project. So, ERW today is $550 per ton. It's projected to decline to 100 by 2040. So this is a real problem for enhanced rock weathering projects because they're super cash strapped. Everyone says the thing I just said about the tragedy of commons problem, essentially. This will be cheaper later. I can buy it then. But it's really appealing for them to buy that stuff today, to sell their forward carbon contracts today so they can raise cash upfront for these projects. Now, let's say that Undo can sell tokenized forward carbon credits into one of these imaginary pools I talked about, right? They could go to Deloitte and say, we'll give you a 50% discount on the projected cheap price of 100 bucks for ERW in 2040 today. That will help us raise 50% of the project costs upfront. We're going to keep the first 2 years, and we're going to sell them into those pools that I talked about, because I think the price will be good for now. But you have a lot of significant upside potential for holding those now, right? They're not just credits that you retire. They're actually sitting there, and they might be worth more later. After this, let's say they do that, they fund it, then they want to pursue a net neutral strategy. Don't worry, you don't need to know what that is. I'll tell you real quick. Sorry, let's go back there. There we go. So what they have here is, if they then go and buy NCTs as well, they have NCTs, which are projected to go up, forest carbon, going to be more expensive in the future. Enhanced rock weathering, going to be cheaper in the future. So if they open up a perp long position as a hedge on NCT, they can go long, and on ERWs, go short. So they don't actually care which way the market goes, right? This is super simple, by the way. Like, I'm neglecting a ton of complexity here. The point is just that if you make these folks buy these contracts, they now have a way to not care about them being worthless assets. We can just get them to move, right? So, conclusions. I think that we need to evolve pooling of these projects so that they're much clearer to corporate purchasers. I don't think you should follow everything I said here as just an example. But this will unlock the forward contract opportunity, I think, right? It also brings that clarity and transparency we all want to see in the market, because it's still not there, right? New financial primitives like perps will then enable these folks who then participate in these things to hedge their positions and just not care about where it goes, and that way they can deploy a ton of capital. I want to reiterate what a lot of other people have said here too. This little working group that we formed around this project is called Fast Forward, but we do want you to move slowly because project developers and real life people are involved, right? And if we iterate on this in the right way, with the right data, from the bottom up, we can really unlock like transformative liquidity for these projects. Like I said, there are many, many unaddressed challenges here. There's the governance of the projects that goes into the pools. There's regulation. The CFTC will come talk to you the second you try to do this, right? But lastly, I would just like to acknowledge everyone who helped me with this. Honestly, there's a ton of people. Peter Olivier at Undo, Tom Duncan at Earthbank, Farouk Gondor at Neutral, Sam Bennett, Ryan Christopherson, and Gregory Lando at Regen, Icarus Jansen, Elena Merg, John Hoops, Denver, and everyone at BikeHow. Also, my family who hasn't seen me in 3 weeks. And since I think I have enough time for this, this is me. Co-founded Cerulean Ventures. We invest in refi. If you're working on any of this, come talk to me. And thank you. That's it.